Well, the IPO market is looking up again, and we are here bringing to you yet another interview that's going to give you all the information that you need about this much awaited IPO. Delivery Limited is all set to hit the exchanges with its public issue. Let's get to know more about this from our guest, Mr. Amit Agarwal, the Chief Financial Officer at Delivery Limited. Welcome to the show.
Thank you for hosting us, Astha and Upstocks team, and
Thank
a very
you.
welcome to all the viewers who are interested in understanding.
Absolutely pleasure. So first of all, Amit, congratulations to you and your team on going public. Could you just take us through, the quick highlights of your public issue?
Sure, Astha. So Astha, logistics is a $200 billion non-discretionary market in India, and it's going to grow to about $300 billion in next 5 years. Delivery works across 5 segments of supply chain and logistics in express parcel, express freight PTL, FTL, supply chain services, and cross-border services. Despite being the largest and fastest growing 3PL logistics company in India, we are just 0.5% of the logistics, less than 0.5% of the logistics market in India. Delivery is an asset-light business, which basically means we don't own any land or building. We own a handful of 300 out of more than 8,000 trucks, which operate for us across the country. And we run a common interoperable infrastructure across all lines of businesses. And we heavily rely on automation and technology to deliver superior services to our customers.
All right. And with this, we move ahead to the next question here. Could you just describe your core business to our subscribers? Are you a tech company? Are you a logistics company? What is it like?
We are a tech-enabled logistics company, which basically means that we use technology and hardware automation to deliver our services. As I was saying, in India or anywhere in the world, typically logistics companies invest in either land, building, or fleet. We do not invest in either of the two, land, building, or fleet. We invest in developing software. We invest in building automation solutions to deliver superior services to our customers. All in all, Delivery is a tech-enabled logistics company. We are a brick and mortar business, and but we do it in a manner which we believe is differentiated from rest of the market.
Understood. Now, just addressing the elephant in the room, COVID must have been an extra challenging period for the company. While the cities were locked down, e-commerce business, it picked up. So what kind of opportunities and challenges did you guys face as a logistics firm?
First of all, during the first wave of lockdown, all logistics businesses came to a grinding halt because there were very severe regulation on what were essentials and what were non-essentials. And if you look at e-commerce primarily has non-essential goods moving around, which could be electronics, apparel, small novelty items, or general merchandise of the home. There was a very small fraction of our business which catered to FMCG material or pharma. However, the good part about our systems was that we were able to identify what were essential and non-essential goods, and our location intelligence systems were able to decode addresses to a street level to identify what were red zone, orange zone, and green zones. And hence we were able to retool our network to deliver essential goods in all zones or non-essentials included in certain zones as and when the government eased the restrictions. Our business did not see a surge of orders unlike some other online industries, because online shopping was not as much about entertainment driven. There are certain categories in e-commerce such as food which work as a source of entertainment or satisfaction for people. So we didn't really see a surge coming in of orders in our business. What we saw was new customers joining e-commerce bandwagon, and those customers are going to stay and adopt habit of buying more and more goods over a period of time. But we were not a business which suddenly saw many customers coming in and going out. Those were different industries like food or groceries businesses. We have little or no exposure to those industries. The second wave was more challenging for our society, where our country was grappling for oxygen. Delhivery was able to leverage its network around the world to procure tens of thousands of oxygen concentrator, many oxygen plants and cylinders, import them from all over the world, bring it to India, and then distribute to the nooks and corners of the country as and where the orders came from. We did this on no profit, no loss basis. And this is something which was done as part of our CSR initiative.
Got it. Now, moving ahead, you've been quoted describing Delhivery as an asset-light business, which is unique if you talk about a logistics firm. So is this going to be your strategy in the future as well?
Absolutely, Astha. We have no reason to own land or building or even fleet. Land ownership is a very different kind of business with very different return profile.
Yeah.
We are not in the business of owning or developing land or maintaining land and building. We are in the business of optimizing the use of building fleet, manpower through technology and automation, and then delivering superior service to our customers. India has more than 4.5 million trucks. So even if Delhivery decides to buy 8 or 10,000 trucks for its own, what value would we create to the ecosystem?
Yeah.
I don't think owning additional 8 or 10,000 trucks in a country with 4.5 million trucks is going to make any difference to it. So we have no intention to own land, building, or fleet in our business.
Got it. Well, now, Amit, earlier the size of the IPO was 7,460 crore, but now it is 5,235 crore. So why did you choose to trim the size of the issue?
Astha, if you look at our DRHP, you will find that out of 7,460 crore rupees, almost 2,460 crore rupees was secondary offer for sale by the existing shareholders of the company. Now, existing shareholders of the company have decided to hold their stake longer in the company and would like to sell nearly half of what they originally planned, which is a sign of their confidence in the company's future prospect. If you look at this 1,235 crore of what they are selling in the OFS, it's a very small fraction of their total holding. It's 4% of overall equity of the company at the top end of the price range. And if you look at our primary issuance, it is only about 4,000 crore out of the 5,000 crore primary issuance earlier. Now let's look at how the business has performed over this period of between DRHP and RHP. Okay. When we filed our DRHP, we were at an adjusted EBITDA of about minus 3.7%. And when we filed our RHP, we are at an adjusted EBITDA of minus 0.7% for the 9-month period, which basically means that our profitability has significantly improved during this period. And hence, we don't need as much cash as we anticipated. We will have 4,000 crore from the IPO proceeds. And as of December 2021, we still have about 2,900 crores of cash with us. So we are fairly well capitalized for our future plans on both organic and inorganic front. And most importantly, our bankers advised us the amount of capital we have with this issue is sufficient for us to grow our business for a foreseeable future.
Makes sense. Okay. Now, talking about, the current scenario, the markets have been very volatile of late. And added to that, we've seen a lot of tech unicorns now trading way below their listing price. So does that concern you?
Astha, it's not our job to comment on other people's business. I'm here to present our story. And I would like to take this opportunity to highlight certain few important facts about our business. Delhivery operates in a very large non-discretionary market. As I said, this market is over $200 billion and it's going to grow to more than $300 billion. Logistics will not degrow even if economy does not grow. Every time products are manufactured, goods need to be moved. The chair we are sitting on, the table on which our laptop is, or our laptop, or anything in and around us needs logistics from its point of manufacture to the distributor and eventually to the retailer. So this is a very, very core sector to the economy. We are not in a business of changing people's habit, and hence we are in a business to bring about efficiency of goods movement. Secondly, we are a business which is nearly break even on adjusted EBITDA basis for 9 months of FY22. As I said earlier, Our adjusted EBITDA for 9 months of FY22 is minus 0.72%. And this is despite the fact that there is a significant seasonality in our business where second half of the fiscal year is typically larger than the first half of the fiscal year because of festivals and general shopping trends. Thirdly, we have a very strong and independent board, and that's been the case for last 5 years. If you go back into time and look at our filings, you will find that we have had independent directors on our board for as long as 5 years. And we have always believed in very high corporate governance, and we have run like a public company internally with an independent audit committee, independent nomination and remuneration committee. Hence, we have always championed corporate governance, and we will continue to do that.
Now, moving ahead, Amit, you have been on an acquisition spree in the recent years. Now, with the IPO proceeds, do you continue to plan inorganic growth, and what kind of companies would be your ideal targets?
Astha, if you look at our acquisition history, the companies fall into primarily two categories. Companies where we have bought them or assets we have bought in with revenue and profits. These would include like SpotOn or the India assets of FedEx and Aramex, or our significant minority stake in Falcon Autotech. And the second category would be where we have done capability acquisitions, such as Roadpiper, PrimaSeller, and TRI Robotics. In the first category of acquisitions, those are the companies or contracts where we get real revenue and real profits, and we judge those businesses by their profitability and return metrics when we make those investment decisions. Very interestingly, on FedEx, Aramex, Falcon Autotech, these are long-term partnerships for the business. FedEx and Aramex partnerships give us access to reciprocal networks around the world, and they also give these companies an access into our network in India. So it's a mutually beneficial relationship. Similarly, in case of Falcon Autotech, we'll be co-developing new products together, to which delivery will have exclusive IP in India, and we'll be able to take forward our automation strategy ahead of the curve. Other capability acquisitions such as Roadpiper, PrimaSeller, or TRI Robotics, these are small capability acquisitions in areas of FTL, fleet aggregation, D2C customer management, and drones and robotics. So we will continue to acquire assets in both cases where we will have companies with profits and revenues and profits, and companies with certain unique capabilities on top of which we would like to build. However, I would also like to point out that we are not a venture capital fund, and we neither intend to buy or invest in unrelated businesses or buy small, insignificant minority stake in any businesses.
All right. Moving ahead to the final question before we close. Now, you have earmarked the sum for organic growth. Now, can you help us understand how and where will this be deployed?
We have earmarked half of our primary proceeds for organic growth. Organic growth is about doubling down on existing business lines. So we have Express Parcel, Express PTL, supply chain services, FTL, and cross-border businesses. These are the existing business lines of the company. We invest in developing high-quality automation and storage capacity across the country, which allows us to expand our business. We power these fulfillment centers or automated sort centers with our technology to be more efficient and be more reliant. We will continue to invest our organic portion of our primary issuance in doubling down, in expanding the capacity and delivering better quality of services to our customers.
All right, got it. Thank you so much, Amit, for joining in. It was a pleasure having you here with us today, and we do wish you all the very best for your IPO. Thank you so much.
Thank you, Astha, for having us.